Thank you all for joining the webinar today on Lease Accounting and Audit. Maybe some of you, this is top of mind right now as you're going through November, December for your final closes of the period, getting audit ready for Q1 of next year. And so wanted to have this webinar to just give some reminders of things to consider to really prepare yourself for this year's audit. I will say, if you thought that Denise Hinkle was going to be on the line today, in fact, she unfortunately was sick and was devastated to not be able to join, but we have a replacement. Austin from the Occupier Team is joining as well. So it's going to be a very, very great session today. So glad that everyone is here. If you want to enter into the chat where you guys are dialing in from or zooming in from. Currently, I am in New York City, but I live in St. Louis. So it's been very, very enjoyable in New York. Beautiful weather. It's a perfect fall crisp day. So love hearing where everyone's from. Austin's hailing in from Toronto. Not sure about everyone else. So a little bit about me. I'm the SVP of Finance at Occupier. I started my career at PwC on the audit side, then transitioned into a consulting role that helped with more technical accounting. So really those were my first exposures to 842 compliance on the audit, and then technical accounting consulting to help people adopt in 2019, and still definitely helping people adopt now. So I've gone through many of implementations throughout my time, and so I've felt a lot of pain that maybe some of you have felt or still feeling throughout 842 compliance. So definitely want to share some of my experience. And so I'm joined by Austin. I'll let him do an intro as well. Again, not Denise, unfortunately, but equally as good. Austin.
Thanks, Lauren. Pleasure to meet you all. So as Lauren mentioned, I'm a senior solutions consultant here at Occupier. Actually, very similar background to Lauren's. I started my professional career at Grant Thornton in auditing large public companies. After that, I, similarly to Lauren, transitioned over into an advisory capacity where, similar to Lauren again, helped in technical accounting consulting with transitions and other difficult accounting transaction matters. And then after that, I transitioned into a controller role where I there too helped that company transition to the new revenue and the new lease accounting standards. And then obviously now I'm here at Occupier helping all our awesome customers transition and maintain compliance with the new and complicated lease accounting standards. So excited to go through this together.
Yeah. So our roles at Occupier too. So Occupier, for those of you that don't know, we are a lease management software. And so we help customers from onboarding to ongoing questions that they have. We're also heavily involved in product development to make sure that everything that we release is going to be suiting the needs of the accounting folks out there, from controllers to accounting managers to even a CFO, having something that works for each one of those levels. So here is what we have on deck today. I try to make webinars as engaging as possible. So while we have a deck and we have things that we want to cover, certainly if you have questions at any point in time, you can just add it into the Q&A and we can try to go through that in detail. Even if you want me to unmute you, you could ask your question directly to us, because I'm sure most of you guys have some challenging questions that maybe you want to bounce off us. So certainly we can do that. But the goal is to, again, try to prepare folks for their year-end audit and just some reminders of things to prepare you for success. So the first area is team alignment and lease identification. And it's interesting because these things probably were a huge lift for folks during the initial 842 implementation, but those things never really go away because you're always going to have new leases, you're always going to have new amendments, things like that. And so always kind of staying on top of that. But just to get a gauge for, let me see if let me launch this poll right now, just to figure out where everyone is in their 842 adoption or IFRS 16 or GASB, whatever standard you're on. I just launched that. We've got 2 people fully transitioned. Not sure if you guys can see the poll results. Oh my gosh. I love someone's a pro. Nice. So we've got a little bit of everything. And I want to learn from the pro. We're going to have a question and a couple of slides that I want to hear from you on. So I can end this. So it sounds like we've all transitioned, which is awesome. I can share the results real quick. Which is lovely. So when thinking about the process and team alignment, the first part of that is identifying who's involved. And one of the cool things about leases is that it involves so many different areas of the business that you really have to make sure you understand from before even the lease is getting signed, who's involved. You're probably, if it's let's say it's a manufacturing equipment lease. Let's say the head of manufacturing is probably going to be involved in that, maybe procurement, legal. Then it's going to filter into also affecting not only the accounting team, but maybe the facilities management team to make sure that that piece of equipment is continuing to run. Then FP&A might want to understand how that lease is constructed so that when they're forecasting, internal audit. So it really impacts so many different areas of the business that sometimes the easiest thing to do is to just say, okay, what is the life of this lease and who is touching it along that life, that journey, to figure out who may need to be involved in some sort of like steering committee to figure out, okay, here's what we want to accomplish. And these are all the different stakeholders of each. And so this slide kind of represents that this is more specifically for a real estate lease. There might be a tenant rep broker that's negotiating the terms or helping to scope out the actual spaces. Then there's the lease administration part of it for making sure that we're paying the right rent at the right time. We're not missing any escalations. And all of that is feeding into the lease accounting team. So how do you get everyone on the same page? First step is figuring out who the heck is involved. And then next is the lease identification. A lot of people, again, did this getting ready for 842 or IFRS 16, but it's a continuous discovery to make sure that there aren't additional leases out there. So wanted to, again, remind everyone what a lease is. There must be both an identified asset, either explicitly as in the specific floor of this specific building, or it could be implicitly, meaning that a specific piece of machinery is required to fulfill this contract. Therefore, this piece of machinery is the identified asset. But you also have to be able to control that asset substantially. A lot of things came about with embedded leases, a huge buzzword in 842 and IFRS 16, and looking through leases that, again, have these two criterias, but are not shaped. They don't smell or look like a lease because maybe they don't have the word lease in the actual agreement. Just because that's the case doesn't necessarily mean that you don't have a lease arrangement there.
Yeah, definitely. And an example that I've seen recently and across quite a few of our customers in the restaurant space is soda machines. So if you have a soda machine in your restaurant, and as part of that arrangement, you don't pay for the machine, you just pay for the supplies, the replenishment of your Coke syrup, your Sprite syrup, and the CO2 machine, or the CO2 bubbles. As part of that, you're not technically paying for that soda machine, but that is often considered an embedded lease because they are essentially leasing you that machine for an extended period of time. And in exchange, although you're not paying for the machine itself, you are paying for those materials. And as part of that arrangement, they're giving you access to that machine, which is an identified asset that you have the right to control for that term. So that's just an example of a common one that we typically see across our customer base.
Yes, I was actually just thinking about that because our Occupier New York office has a bevy, and thinking through, oh, this is probably a lease. So here's some tips to find some of your leases. I mean, first and foremost, you can ask around. You probably did some surveys, maybe again during the initial 842 or IFRS 16 adoption. You can continue to use those surveys. The survey could be to department owners to say, hey, do you have any new leases that you entered into during the period? If so, what are they? What are the contracts? Can you provide them? And you could kind of ask different questions around that just to department owners, make sure you're covering all of your bases. You can also do follow the money, meaning you could look at your cash disbursements listing for the past 12 months, segregate it by vendor to make sure that, okay, any other consistent month over month spend that is not a software service or a consultant, you may want to check around there and make sure that that is not a lease. You can also review work done. So let's say that you're looking at the maintenance expense line and trying to figure out, oh, something was being done to this new building, but I don't have this building on our lease population list at all. That could be a red flag that maybe this lease was missing. And then last but not least, you can always ask for help. Sometimes, let's say that you're starting a new role and you don't have all of the lease details that you would like to have. You can always ask the landlord for certain information, maybe that they have it better documented than maybe your company previously had it documented. So you always go to the source and ask questions.
Yeah, and I think just to reiterate there, number 2 is typically a test that I used to perform quite a bit as an auditor, and I know people are still performing just to test the completeness of the population. So that's something I generally recommend doing at least once a year, before maybe around planning time, just to make sure you've captured the entire population. Because in a large multinational corporation, as an example, those smaller leases are easy to miss, and although they might be small in nature, there might be quite a lot of them that can add up to a material amount. So obviously staying on top of that stuff to avoid audit findings is generally a best practice throughout the year.
Yeah, totally. And someone mentioned that the bevy machine may not be a lease unless there is a minimum supplies component. Totally 100% correct. If it's only variable, then it's not going to have any lease consideration. However, if there is a component of you must order, which I would love, gallons and gallons of grapefruit bevy sugar. I don't know what flavors it, but then it would trip into a lease for sure. And also the other component too that may trip it is the length of that lease. When I've worked at companies that have had bevies, this isn't our own bevy at Occupier. It's usually sometimes a short-term lease, so that could also trip it to not be considered for 842. And then another good point that an attendee brought up was overseas, you can often find, say, a copy or lease that is paid through a manager's monthly expense report. That is wild. Totally true. Checking through expense reports for sure to see what's going on. That's an awesome tip. So once you found all of your leases, the next best thing is to centralize that lease data, because you want to make sure that all of the information you need to pass that audit is readily accessible by whoever needs to access it. It's in a place that you kind of understand the data flow of it. So centralizing all of that lease data is super important. And you can use a platform for this, and certain things that you can also do by leveraging a platform is reviewing your lease payments, whether it's monthly, quarterly, annually. You can also create your journal entries, track anything that's changed throughout that, and also have different reporting for your disclosures, and also just kind of like the month-end management or quarterly end management of the leasing information. So slightly easier to centralize if you're leveraging a platform, for sure. And on to polling question number 2. For those of you that have transitioned, what was your biggest hurdle? And I would love to hear what the pro has to say here. You might have to add some context in the Q&A. Oh, yes. Launch this first. Natalie, I'm going to allow you to, or Natalia, I'm going to allow you to talk if you want to come off mute since you raised your hand.
No, we just couldn't see the question in order to answer.
Got it. Got it. Gosh. I don't know if we planned this, but everyone's answered one of each item. On this, and share the results. Holy Honda.
Even split.
Yeah, wild. Okay, so now going into policies and controls. When you're thinking about the audit, I think one of the main concerns is always around the data integrity, especially around what has changed during the year. So making sure that, one, you have a complete population of changes and a complete population of your leases, and also making sure that all of those changes were complete and accurate. So having controls to ensure the accuracy, integrity of the lease data, having it properly documented, including decisions around things like your discount rate or why you included certain expenses versus others, is always going to be really helpful to help pass the audit. And with that, thinking through streamlining your process. Think of like these as different pillars to help with this success. You want to make it consistent so that you have a playbook that every single lease is run like this. You know, of course, there may be differences for a real estate lease. You're going to look for things like the tenant improvement allowance versus equipment leases. You're not going to be looking for that because maybe an equipment lease is just 3 pages long and it's a little bit more straightforward. But you should still have a consistent process around every lease. You're going to do X, Y, and Z. And the deliverables month over month for your journal entries, any other reporting that you want to give out to folks is going to be consistent. So it starts with that. Documentation, always having it written down helps drive consistency, because let's say that different people are doing it. Well, if you have different folks, then having it written down is going to really help enforce that consistency. Next, you want to make it accessible, making sure that documentation assumptions are easily accessible for everyone on the lease so that they understand. Incorporates this into education because, hey, folks, especially people that may be performing something within the lease lifecycle process that are not accountants, they generally need to be constantly refreshed on the goals of 842 or IFRS 16 as it applies to their role. So having regular trainings for folks that are not on the finance and accounting team is super helpful to make sure that you're not missing anything.
Yeah, and that one's big. I've seen quite a lot of instances where heads of development or heads of real estate have their job is to negotiate the best deal a lot of the time. And in doing that, they don't necessarily think about the ramifications or implications on their finance team. As like crazy example I've seen in my past life, a mining company, they, instead of paying cash for their leasing arrangements, someone thought it would be a good idea to pay in gold bullion. Obviously that loops you into various other accounting standards outside of just IFRS 16 or ASC 842. But that's just a crazy example that I've seen that caused enormous hurdles organization wide. They had to call in accounting advisory teams, which obviously came at a big expense, which goes to show you, although it might have seemed like a good deal at the time, obviously there's ramifications across the board because of that one decision somebody made. So if that person was educated at the outset of the adoption of the new standard, perhaps they would have reconsidered that choice or strategic decision. But again, that's a good example there. And then going back to the documentation piece, I saw someone in the Q&A mention that materiality is often a thing to consider, although it's not always mentioned in the standard. It is something that is obviously recommended to consider. And that scoping document that outlines your policies, controls, assumptions, and making that accessible to your various organization leaders can often help you get that information relayed to you in an appropriate amount of time. Where if you say, hey, a copier of $1,000 a year, I don't really care about, but anything higher than that, please send that to me so I can make an account for that and obviously report on it. That often goes a long way as well.
Yeah, totally. I think it's always helpful. Of course, it changes based on the maturity of the company that you're working at, but I think being involved from a technical accounting standpoint to review the leases before they're even signed is super helpful, because to your point, if that would have happened during your example and you wouldn't be paying it in like a non-cash item, it probably would have illuminated a lot of things. Like all of the money that was saved by doing that was especially a cost based on all of the technical accounting, it seems, like all the consultants that worked. So if it's feasible, and you have a larger company and a little bit more mature, getting involved in these bigger deals, contract negotiation and things before it gets signed is always super helpful.
And we did have a Q&A question on whether or not the slides will be shared.
Oh, yes. We will be sharing the slides and the recording, I believe, after the webinar. And I also love this. Transition is a second job while you're doing your first job. Isn't that the truth? Oh my gosh. And the one thing that's always lovely about accounting is that it's always changing. So it's great. Onto the polling question number 3. Let me launch it before I go back. So who is responsible for controls at your organization? Wonder if we've got a couple of me's, controllers. No one. Looks like we've got all of the results that we're gonna get. So we're about, yeah, half and half, me or no one. If it's not you, it's not going to get done, I guess. So when we think about process controls relating to really anything for the financial statements, leases is no different. It always comes back to these 5 financial statement assertions, and it's existence and occurrence, completeness, valuation, rights and obligations, and presentation and disclosure. And so you want to have controls that specifically address each one of these areas, and you can have multiple controls, or you can have complementary controls. Maybe one control is hitting on multiple assertions, but you want to make sure that each one of these is getting covered somehow, some way. And we'll go through some examples of what that would look like. So existence and occurrence is just making sure that it actually happened. And so you can do this by looking at lease reconciliations. You can reconcile a sample of leases in the lease register to the actual lease document to make sure that it is in fact a real lease. You can review any modifications for changes to make sure again that those have definitely happened. You can make sure that all of the data, meaning the recorded and actual payments, that those are aligning. Sometimes they may be slightly off based on any variable expenses that may not be known at the time. But again, putting in some reasonableness checks to make sure that, hey, I was supposed to pay $10,000 for this lease, but really I'm paying, $5,000. Did I lose? Did something happen here that I may not be capturing? So you can do a few different things there. Also completeness. We spent a little bit of time going through different things, how you can ascertain completeness. I think just to touch on it again, like having an annual 842 training or a standard training on this for folks outside of the finance team is super important, because if folks don't know what a lease is or the definition of it in terms that they can understand, they're never going to send it to you unless you have a full-blown process of reviewing all of your contracts, which you may or may not want to be doing anyway, but making sure that folks kind of understand that they need to send it to you. Valuation and allocation. This is around that the value of the lease liability and right of use asset on your balance sheet is in fact correct. So different things that play into this is the lease classification, your discount rate, because that's going to set, your lease liability and then your right of use asset. This one's actually really important for if you have any renewal or termination options, properly documenting whether or not you're reasonably certain to exercise those options, because that can change the valuation of the right of use asset and lease liability fairly dramatically. I think even more so than the discount rate, because if you have a 5-year lease with an option to renew for an additional 5 years at the end of year 5, at year 1, at lease possession date, you have to figure out if you're going to include all 10 years or just the original 5 that you're locked in for. And so that can dramatically change the value because it's an additional 5 years on top of it. So making sure you're documenting why or why not you're including renewal and termination options is really important. And then also, if you're using a software provider, getting the SOC report, reviewing that to again make sure that the validity of the calculations that a software like Occupier is doing is correct.
Yeah, and one thing I'd like, this slide is particularly applicable today due to obviously the turbulent economic times. But one thing that I've seen a lot in our customer portfolio is fleet agreements. So whether they're leasing a fleet of forklifts, trucks, delivery vehicles, whatever the case may be, historically they would have been classified for these particular customers as operating leases because they weren't tripped up on any of the other criteria. But recently, due to the higher interest rates and obviously the higher payments and stuff like that these customers are paying, they're now finding, and we're finding, that a lot of these leases that were historically treated as operating leases are now tripped up into finance lease treatment. So just something to be mindful and wary of when you're actually doing your classification tests for new leases, if you do have a lot of those equipment leases, and not just kind of reverting to what you historically did. So being able to document that and report on it is a huge value add, especially when or if the auditors come asking kind of, did you classify these appropriately?
Oh, shit. Yeah, totally. I think that could be super common. Yeah, I think a lot of our equipment leases we see now, people are taking a second look at, oh, shoot, is this now a finance lease because of the interest rates being so high, and now tripping the present the fair value test. So great call out. For the SOC report, so really it depends on the software. If they have, kind of review any SOC report that they will, usually the actual validity of the calculations will be in the SOC 1 report versus the SOC 2 will be more around like the technology infrastructure and controls around that. At least that's in my experience, but software providers can kind of merge some of the things from the SOC 2 report into their SOC 1 report. So there could be different ways that they're slicing and dicing it. Also, good point. Bridge letters are also necessary based on, like, if you have a SOC report that is dated on September 30th and your year end is 12/31, you want to make sure that you're getting a bridge letter for October, November, December, to make sure that nothing has come to the attention of the person who signed the SOC report that would make the representations in the previous SOC report invalid. So Tamara asked another question too. We transitioned last year. We currently are adding new leases that started in 2023 at various start dates. Do we just pick a particular date to obtain the discount rate, or is the rate based upon when the lease started? Great question. So depending on the volume of the leases, you could do it based on the lease possession date. So when it started, that's technically the letter of the law when you're supposed to determine the discount rate. When we have seen customers with a high volume of leases, they may set a discount rate for that entire month based on the tenure of that lease and the underlying risk portfolio of that asset. So for instance, an equipment lease may have a different risk profile than the real estate lease. So maybe they're using slightly different rates, but most of the time you're using the same rate, but it's only going to be different based on if it's a 3-year, is it a 5-year, 10-year lease, things like that. I've also seen companies do it based on a quarterly too. I would, again, depending on the volume, I would start with just doing it based on the date of the lease. But if you have, an accounting policy memo, you could just pick your monthly, quarterly, whatever you want to do and just stick to that. I think just being consistent is probably more important than the decision of what type of discount rate strategy.
Yeah, I think at the end of the day there, to Lauren's point, the technical answer is to look up or calculate the discount rate, depending what method you use for that, as of the possession date. But from a practical standpoint, I think what audit team's main concern there is it going to have a material impact? So if you can substantiate that to them at the end of the day, that looking up the rate on the exact day that you took possession for every single lease, to Lauren's point, that's not always practical, but if you can do some sort of calculation and substantiate that that it wouldn't have had a material impact either way. I've often seen auditors be okay with doing a blended approach.
Yeah, totally. And yeah, I've seen people, if they wanted to do it quarterly, they've run some sort of materiality analysis of what it was or like would have been if you did it the letter of the law way. And usually it is not that crazy of a variance. So that's why you get a little bit more leniency versus the renewal and termination options. You definitely have to have that documented because it swings. Okay, so onto rights and obligations. This is making sure that you as a company actually have the right, but also the obligation to pay for that lease. So you have the right to use it, and things that, you know, can like make sure that you have the rights and obligations is, again, making sure that you can go through like your lease documents and say, hey, this is a valid document. We are paying for this. This is in our possession. We are not, you know, like we don't have any underlying agreements that are understandings that prohibit us from getting those rights or obligations. And I think one thing that can help with this is establishing a clear process for authorizing and approving the lease agreements to, again, assess the validity of these agreements.
Yeah, and this is another area that I have seen a lot of previous, both in my past life and customers utilizing our software to adopt. It's an area I have seen a lot of people struggle with, in particular with the possession dates and relaying that information in a correct in a timely and correct and efficient manner. Going back to our slide earlier on developing a process, and it's even mentioned on this slide, developing a process to relay that information. Without that, it's often hard from a finance perspective to understand when you've actually taken the keys to a new store that's being built or whatever the case may be. And obviously, if you don't have that information, it's hard to know when you're supposed to begin to account for that leased asset, which can obviously lead to various accounting issues, audit findings, whatever the case may be. And on the other side of the coin, what I've also seen, if you don't have appropriate procedures and controls in place, is that, especially in larger organizations where you have a lot of different leases, is leases will often wipe off, and you're technically not supposed to be paying whoever the case may be, but you're still actually paying that person, and you're not even in a leasing arrangement. I've seen this with a wind turbine, an energy company that leased wind turbines and put them on people's properties. And they continually paid these people for 5, 10, sometimes 20 years after they took the turbine off the property, because they didn't have procedures and controls in place to actually take a look at where their turbines were actually still are and what leases were actually still active. So that's obviously an extreme example, but just goes to show you that having these procedures and policies in place can prevent things like that from happening.
Gosh, that sounds like a nightmare. Sounds like my biggest nightmare, actually, is paying it for 5 to 10 years. Oh my gosh, yikes. So I just saw a question in the Q&A. There was talk about review, end of period review to make sure everything is included. Do you then have a lease roll forward report? We do have a lease roll forward report that is super helpful for individuals that are going through their audit, because it highlights exactly where the auditors need to focus their time on based on those changes. We have it on both a high level, if you wanted to look at it from that view. We also have it on a lease level basis too, which is generally a request from every single Big Four during the audit. So super helpful. That kind of leads right into presentation and disclosure. So now that you have everything's right, you have the rights to it. Now the last step is making sure that you are actually disclosing it fairly and accurately. And so there are financial statement disclosures that you have to abide by that are additional for 842 and IFRS 16. Also, sorry, I'm going to move my screen a little bit here. I think an important thing too is to look at the qualitative disclosures too, because based on the nature of the leasing activity during the year or even historically, the qualitative disclosures that your company may be making will be slightly different, especially based on your industry too. And so always something to keep in mind that if something has changed since the prior year, you may need to update some of that verbiage to go along with the numbers. So something that you may want to disclose, let's say that your company has decided to close a portion of its locations. Well, you may want to say the nature, like we have closed 25% of our locations this year. And we're doing X instead. As a result of that, we took a termination loss of X, Y, and Z. So again, it can totally change based on what y'all are doing this year.
Yeah, and to Lauren's point, just on that, by our customers often get asked kind of how do we have templates for that, or how do we go about disclosing that? And oftentimes where I suggest people to look are 10Ks. Obviously, publicly listed companies have a lot more reporting requirements, but oftentimes you can get an idea of the stuff that you need to report there. For, again, whatever the case may be, whether it's a termination, an impairment, something unique that might have happened during the year. Again, be careful that you're not over disclosing, but if you do need some verbiage and kind of structure in a templated form, I often suggest people start there and then obviously pare it down as needed. But just a general tip there for not only leasing activity, revenue, whatever the case may be. They're obviously publicly available documents for a reason, so use them to your advantage.
Yeah, totally. I would probably go with an example that's in your industry and try to find a public company and start with there. My favorite 10K to look at, this sounds like a huge nerd thing to say, but I like, as I say this out loud, is I really like how Chipotle summarizes their lease information. I think they do a really good job of making it super clear what they're doing. So if you want to check out Chipotle's, I like them a lot. The food, it's all right. The lease footnote, great. So this is kind of like going through now just different levels, like kind of when you're going to have transaction level controls, you want to have controls around the actual account balances, and then you also want to have that presentation and disclosure assertion. So this is kind of just like framing it slightly different, because you're going to have transaction level controls around the completeness, accuracy, that it actually occurred, that it occurred in this period. So you're going to have some sort of cutoff test, maybe going into the account balance assertions, making sure that the valuation is correct, that we pick the right classification, the right discount rate, and then that feeding into, okay, am I presenting this fairly and accurately for the financial statement users? With that, we'll go into post-implementation concerns. I figured it would be helpful to just base case go through what a lease modification is and how it would be treated versus a separate contract. So a lease modification is a change to the terms and conditions of a contract that results in a change in the scope, meaning it could be you are getting an additional floor of a building or an additional office within a space. Maybe you're getting additional parking within a parking lot. So you're changing the scope of the lease or the consideration of the lease. So what are you paying? When are you paying it? And most, if those, so when you have a lease modification, there's going to be a fork in the road for how you should be accounting for it. You're going to be accounting for it under the modification guidance or as a completely separate contract. And that is distinguished between a lease modification if the modification gives you an additional right of use that's not included in the original contract. Again, let's say that you are now getting access to the 5th floor and you are currently occupying the 4th floor. That would be an additional right. But is there also an increase in lease payments for that additional right of use? Well, then that should be considered a separate contract. And when you have a separate contract, it's going to be set its own amortization schedule, its own discount rate, its own classification assessment, versus if it is let's say that you just changed, let's say I occupy the 4th floor and my modification was to extend the lease by an additional 3 years. That would not be accounted for as a separate contract because I already was occupying the 4th floor. All I did was change the duration of that contract, or my right to use was extended. So that would be considered a modification. And this slide, there's a lot of things going on here, but depending on the type of modification, you may have to do different things. So if you are changing the assumptions of the underlying lease, let's say that you change the assumption that, you're going back to the example of you have a 5-year renewal option. Let's say 3 years in, you love the space. And initially you didn't think that you were going to exercise that renewal option, but let's say 3 years in, you have invested a ton of money. It's your headquarter office. You think you are definitely going to stay in that place. Well, if you're going to have a change in that level of assumption, remeasuring that lease liability as of that point in time based on your extended lease payments using a updated discount rate based on the date of that assumption change, and then also reassessing your lease classification. So important to note that it doesn't have to be actually in writing in order for you to have a remeasurement event. If you're changing the assumptions, you also want to have like a red flag in your mind thinking, oh shoot, I might have to do something here. Also, if you have a lease scope decrease or lease termination, you want to think when you hear of modification, there is no income statement impact, versus if there's a termination, there will be an income statement impact for a gain or loss based on the change of the right of use asset and the lease liability. Also, getting more and more important. I think that all of the big 4 accounting firms were like, hey, wait a second, are we not doing impairment assessments? And so I feel like we are constantly getting asked about how to assess for impairments, because sometimes you think about impairments in terms of like fixed assets or goodwill, and a lot of these leases weren't on the balance sheet before. So making sure that you're including your impairment assessment for leases in particular and your annual impairment assessment that you're doing. So you could do it similar to how you do it for others, but additional things are, any sort of like legal proceedings that may be impacting your right to use. A common one was during COVID, a lot of folks could not use the dining space in the restaurant because of the legal restrictions. Well, folks were impairing the asset based on their lack of ability to actually have people in that restaurant. Hopefully that has since gone, but folks are still, that was just one example of what could happen. And then I think we're coming up on almost our last slide here. So I think saying audit ready, the easiest way to do that is to be ready with your data 365 days a year, that your data is always up to date, always accurate. You're actioning it. It's in an organized place, centralized lease repository. You have all of your documentation. If you are following that streamlined process 100% of the time for all of your leasing activity, then, you know, it's going to be very easy for you to stay audit ready, right? We have some additional.
I think just to add in there, I think that's the big thing to your point, Lauren, is stressing the 365 piece, not waiting until the auditors tell you they're coming out for planning or interim or even year-end field work. So obviously then it's a scramble. Stuff can easily fall through the cracks. So again, building in those controls, those processes, so that you're looking at it monthly, quarterly, wherever it makes sense for your organization, so that you're staying on top of this stuff and you're not, again, missing those leases and the expense reports at the end of the year because you have a million other conflicting priorities. Looking at this stuff in a organized and timely manner allows you the time and the ability to account for these things correctly and make sure they don't fall through the cracks, right?
Totally. We have a question from someone. Does your impairment functionality automatically change the operating lease treatment to finance lease treatment, or does that have to happen manually? If you impair a lease with an occupier, that change in calculation for the lease expense does happen automatically, so you don't have to do anything outside of just entering in the impairment information. Everything else will calculate for you. I don't know if I missed anything. Our last polling question, let me get this launched. So this is really helpful for us if you want to put into the Q&A your ideas for future sessions, because we love having these webinars and just honestly hearing from you guys about some of the challenges or different experiences that you've had. So make sure you send that to us. So before we wrap up, I'll give a little overview of Occupier. So what makes Occupier slightly different is we have different modules that support every single phase of the lease life cycle, starting with transaction management. So making sure that when you are going through the negotiation of a new lease, organizing that process, to then taking that executed lease into the lease administration. So you can see all of your financials, critical dates, clauses. It's very much a digital abstract of your leases that you can Google essentially within Occupier, anything you want to know about a lease in general or across your lease portfolio on a more macro level. And then all of that information feeds into our lease accounting information, so that really it forces everyone to be using the same information, so that the possession date, it's the same for the lease administration team to the accounting team. Whenever a lease is modified or you have a new lease, the lease accounting team is automatically aware of that, so they can action it based on, you know, what they need to do for those leases. So it's really a force function of making sure everyone's on the same page. And then my email is lauren@occupier.com. If you have any questions or any ideas for future webinars or want to chat through different challenges that may be more specific to your portfolio, we are more than happy to hop on a call and talk about leases. Awesome. Well, thank you so much for attending our session today. A little early, but very much appreciate it.
Thanks, everyone. Pleasure chatting with you all.